Hi, everyone. This is yet another part of our meeting series. The earlier ones were on insurance. We want to start on retirement. And the first of the three series in retirement is on how pension helps in protecting your income during retirement. And this is a recorded presentation, and I believe it will be available as soon as you need it, and it will also be easily accessible on our website. And I believe it will give us insights on how we should save for our retirement and prepare for it, and also ensure that we do not suffer financially during retirement. Allow me to share my screen in order to have a presentation. Thank you. So like I mentioned, this is the first of our presentation on how pension guarantees old age income. And this is a series that is part of what we had done earlier, but now we are starting on pension. And like we had mentioned in the previous series, Holistic is an insurance agency that is licensed to handle insurance, investment, and retirement benefits. The founder is an insurance professional, and I'm very passionate about ultimate retirement for all in comfort. And after such a taxing working life, we all desire to have a comfortable retirement. My name is Yuna Finwa, and I am a retired insurance professional and very passionate about taking care of those who have served the industry, served their professions faithfully, and they need to retire gracefully. We aim to pursue this initiative in order to facilitate our people to retire and gracefully, and also to start thinking about retirement and at an early age, and to prioritize saving towards retirement. Indeed, the best time towards to do this and to start saving for your retirement is when you are young. Immediately, if it is possible, from the time you started drawing your first earnings. It does not matter whether you are formally employed or not. We must fight old age poverty way ahead so that we do not find ourselves regretting and in our twilight years. So the secret is to start saving early in your working life, whether you are formally employed, like I have mentioned earlier, or not. Retirement will surely come, because retirement is a factor of age. And we all know, even our own bodies actually give in to age after working for so long. And what we are talking about here is that you need to practice early enough to start putting in periodic contribution to a registered pension scheme. And this will help in saving the required or accumulating the required funds That is the funds that you require when you retire. A retirement scheme is secure and your contributions are protected under trust and also retirement benefits law under the Retirement Benefits Act. Benefits are not accessible. They are not accessed before attainment of a certain age, and currently is at age 50. All retirement age of the scheme. And this actually enforces discipline among contributors. However, we normally see employees when, for example, when they are changing jobs, they would wish to access part of their benefits. The employee's part can be accessed, but the employer's part, half of it is locked at the moment by law. You cannot access it until when you attain retirement age. However, you can transfer it to another registered scheme for ease of continuity. Finally, we note that retirement benefits cannot be assigned to a third party. For example, you cannot assign them to a bank as a security to a loan. And the question that many of us will ask is, but the law allows that you access part of your retirement savings to purchase a home. What happens is that there is no physical movement of funds towards purchasing of property, but you are allowed to hold the retirement funds up to, I think currently it's allowed up to 60% as a collateral security to your home ownership or mortgage loan. Retirement benefits accumulation. Personal retirement scheme and occupational schemes perform the same purpose of accumulating contributions with interest to a lump sum that is available at retirement age. The scheme may be a provident fund or a pension fund. A provident fund is one that allows you to access your benefits at retirement as a lump sum benefit. A pension fund allows you to access a third or a certain predetermined percentage of your funds as a lump sum. The balance is used to purchase retirement income, which may be in form of income drawdown or annuity. And I think we will, when we get to that, we will be able to get the difference between the two. There is also what we call QROPs, or Qualifying Recognized Overseas Pension Fund. These are individuals with, that is individuals with the pension funds from the United Kingdom. They are facilitated to transfer their benefits into a local scheme, and that scheme must be registered to receive such funds. So it is not a movement of those benefits just to any scheme. If you have a scheme into which an overseas employee would like to transfer his benefits, that scheme must be registered under the tax, under Kenya Revenue Authority. So yeah, Kenya Revenue Authority to access retirement funds from overseas schemes. And this is mainly from the United Kingdom. Benefits access is ideally retirement benefits can be accessed on attainment of normal retirement age as set out in the scheme. For example, it could be the retirement age of a scheme could be 55 years or 60 years, or at least 60 years or 50 years in accordance with the scheme rules. So the scheme rules also specify what early retirement age is. If the normal retirement age of a scheme is 60, normally early retirement age will be set at 55. If the normal retirement age of a scheme is 60, 50, 55 years, normally the scheme will set up the define the early retirement age to as 55 or 50 years. So under the Provident Fund, benefits are accessed in lump sum, like we mentioned, but one can opt to utilize your entire funds to purchase a retirement income in form of an annuity or income drawdown. A retirement annuity is one that gives you a predetermined amount, taking into account the interest income that the fund will be invested at. And once that is factored in, it also factors in whether you would want to have your pension guaranteed or not. It could be guaranteed for a period of 5 years, 10 years, 15 years, or even 20 years. The selection as to the amount of guarantee you would like to have is solely dependent on the person who is receiving the annuity, and also dependent on his age, on his old age commitment. For example, you could have young children who are still dependent on you despite having attained a retirement age. And therefore, you would want those children to be protected in the event that you happen to pass on during your retirement age. And in such circumstances, you will find it prudent to adopt a long guarantee period, like 20 years or 15 years, so that within those 15 years, you'll be able to take care of, you'll still be taking care of those dependents. And in the event that you happen to pass on, the balance of your pension up to the guaranteed period will actually be availed or paid to your estate to be able to take care of those dependents. Under the pension scheme, a fraction of the benefits, mainly a third, is accessed as a lump sum, and the balance is used to purchase an annuity over the retirement period. Maybe it might also be good to mention that the annuity benefit is payable over the guarantee period and life thereafter. It can be taken to cater or to respond or to take care of inflation by ensuring that you include an escalation factor into your retirement. Probably at this point, it's good to differentiate between an annuity and an income drawdown. An income drawdown is basically your fund at retirement, and you start drawing a fraction of it on a monthly basis, a percentage of it. And what happens is that it is important to note that you are still in control of the entire fund, and therefore it will be prudent for you to get a statement at the end of every year. Benefits paid out are actually consumed, and they are reduced, or they reduce the balance of the fund. The fund that remains also earns interest at the declared rate by the fund or the insurance or the company that is investing your funds. And usually what happens You can draw it for a period of, say, 10 years, and you cannot withdraw within a year more than 15% of the fund. So it is good to get to understand that, and depending on your needs, if you have got high financial needs, probably you may find income drawdown as a more attractive option, but it does not have the guarantee as the annuity. And should you outlive your fund, what happens is that the residual fund over the period, or at the end of for example, the 10-year period will be utilized, can be actually withdrawn as a lump sum, if that was a provident fund, or it can be utilized to purchase an annuity. And of course, the annuity will be based on the amount or the balance at your fund at the time of purchasing that annuity. Why is it advisable to purchase an annuity for retirement? An annuity is a regular payment received in retirement, and this is in exchange of your accumulated fund. So what you do, you actually surrender your accumulated fund to the fund manager or to the insurance company. And what happens is that from the point that you surrender your funds, the company gets into an agreement with you to pay you regular income that is established at that time. The principal fund is actually guaranteed, and regular income is also guaranteed for life. Annuity payments can be escalated to minimize inflation impact. Sorry. This is because, of course, if inflation has got the effect of reducing or scaling down your income. If you get a fixed amount of income and it is not adjusted, for every period that you move on, the goods or the value that of goods that you could purchase in the previous year becomes less. And therefore, to cater for that, it is advisable to include an escalation factor in your annuity. Annuity payments are protected, and they can only be paid to you. They cannot be paid to, you cannot assign annuity payments to a third party. You can't assign them as a security to a loan or to a bank, and you cannot assign them to another party. Beneficiaries only get assigned the benefits if you happen to pass on during the guarantee period. There are questions, key questions that most people would need to consider, or they would bring out at this point when you are thinking about purchasing an annuity. And one of the questions is, who tells you that I will live to retirement? Most people, especially when you are very young, when you are in your 20s, if retirement age of an organization is 60, it is very difficult for a 25-year-old to visualize themselves at age 60. But it is also worth it to mention that to those of us who are retired, we also started working at 25. So retirement is actually a reality, and it will surely come. And the answer to this is nobody knows. But should you live to retire? Yeah, the assumption is all things being constant. You are healthy. Your life is not interrupted. You will surely live to retire. And nobody would like to answer the questions that you will have. For example, how will my needs be met? I would rather deal with the questions now. Or where shall I stay? How will I pay my rent? How will my electricity bill be met? How will my medical expenses be paid? Even if you have a medical scheme, assuming you have a medical scheme, at retirement, of course, the medical scheme that you were enjoying, the support of your employer, that support will go away and you still have your body to take care of. And therefore you will either have medical bills to pay or premium to pay to your medical scheme. And therefore, because of that, it is important to answer those questions pretty early, and hence the need and the essence and the importance of saving towards a retirement fund. The other question that most of us will encounter is, why should I wait to enjoy my money at retirement? Especially for an individual who is changing employment. They will say, why? I have worked, I am young, I can get another job, and I'm still energetic and I can work. So they would not see the logic of waiting until you are 60. The answer to this is that you are currently on a regular income and you have the energy to earn. That energy in retirement will be gone, but your needs will not go away. It is the unfortunate reality that we wake up to, and it is very sad. You imagine somebody who is doing heavy physical work. For example, I like looking at the young people who are working as mechanics and they are operating a garage, for example. The kind of tasks that you find very easy to do, you will find it very difficult to do them when you are old. For example, you can easily get underneath a vehicle. You can easily, very quickly lift up or use the jack to lift up a car, and you will not have any part of your body that will ache. But at another age, when even changing the tire of a wheel, you'll find it leaves you with some backache. And therefore, you would prefer to have somebody else do it. And that is just an example. And therefore, when you are retired, when you are old, when your energy is gone, even if you still have that garage, you will need an assistant. You will need to step aside. You will need to retire and leave that younger person and more energetic person to do those duties that you were doing when you were young. And as you retire, remember your needs will still go with you. You have your bills to pay, you have your medicals to take care of, you have your vehicle to maintain, and many other expenses that you incur as a person. Hence, I think it makes sense to put aside some part of what you earn when you are energetic to take care of you when you are not energetic or when you are old. Why can't I invest? This is another question. Why can't I invest in a plan which will only be giving me interest on my lump sum amount? For example, this is a question that most people, especially Provident Fund members, they will, most of us, of course, feel like our money is more secure when it is in our hands. You feel in charge, you feel in control, and therefore you wonder why you should give this money to somebody else to invest it and give you a little income, or give you an income from that in exchange of that lump sum amount. And my answer to this is an investment manager will act or always act on your instructions. If, for example, I'm given 10 million to retire on or to retire into, and start utilizing, decide how I'm going to use that 10 million to manage my life as long as I live from that date. If I decide to put this 10 million, I may think it is prudent to put the entire 10 million to a fund manager who will just be giving me interest income on that money. Yes, that can happen if you give your fund managers those instructions. But remember, the fund manager will always act on your instructions. Tomorrow down the line, or in another 3 or 4 years down the line, you will find an interesting venture, but which will require funds, which will require money. And you go back to your fund manager and you tell him, out of the funds that I have invested with you, I would like, for example, to remove 3 or 4 million. The fund manager will do exactly that. They will give you the funds, but they will not follow. Then they do not have the capacity and they do not have the obligation to follow to see that the venture into which you are putting your funds will actually give you a return, or it will not sink and not come out. So a mistake can easily occur and the entire fortune is drained. So we are not saying you cannot invest your funds with a fund manager. You can, but it is very volatile, especially when this is your terminal retirement fund. The terminal retirement fund should be invested and taken care of, and it should be even protected to ensure that it does not get finished before you get finished. That is, your retirement fund should not cease. It should not end before while you yourself, you are still alive. And I think with that, it would be a good point to end this presentation. And I hope you find it insightful. And I want to end with an input that I have got from a psychologist. And this is a psychologist's perspective, that people whose lives are not put together, especially financially, are highly irritable and prone to slide into depression. And therefore, you need to guard yourself. It is important to ensure that our retirement earnings actually, or the retirement fund that we have accumulated during the working life, it is used and utilized prudently to ensure that we are able to live on it. It should be protected just to ensure that you do not find yourself moneyless as a retiree. Otherwise, it can be a very, very serious end. And I think with that, you will be able to access me as the presenter of this program on email. You can also book a session. You can also chat me on WhatsApp. If you want, for example, to book a session, you just click that book a session, and you'll be able to see a form. When you get to this form, you put your email address, you put your telephone number, then you put the time when you are available, and yes, you also indicate the most appropriate time when you can be accessed. And then you choose. When you choose, you'll be able to choose whether the question is on insurance, investment, retirement, or any other. You are not bound to put a question only based on the presentation that I have made. And then even if it is any other, you can put it there, and you click the submit button, and the document will reach me, and I'll be able to access you. And I think with that, I'll close this presentation. Thank you very much for your attention. And I pray that you find it useful and that you find it insightful. And please do not hesitate to contact me in the event that you need more information about regarding your retirement savings. Thank you, and have a blessed good evening or good morning, and I look forward to hearing from a number of us. God bless you. Thank you.